Let's talk about cost of goods sold. The cost of goods sold is the price of buying or making an item that is sold, hopefully at a higher price than the cost, of course. It is also known as COGS, and sometimes just as costs. It most often represents purchases of inventory items sold by a retail business, as well as certain costs for labor, sales, and distribution. Bear in mind that labor costs mean more than just salaries. It also includes payroll taxes, health insurance, vacation time, and other benefits. Inventory plays a very important part in calculating the cost of goods sold, and how that inventory is valued is critical. The amount of inventory shown represents the cost to purchase or manufacture any unsold goods. Inventory on hand at the end of the year is referred to as ending inventory. The ending inventory then becomes next year's beginning inventory. The rules for cost of goods sold generally only allow a deduction for inventory sold during the year. The remainder of inventory can be deducted in future years when it is sold. The workbook describes several alternate ways of valuing ending inventory. Be sure to review that section. Let me give you an example. Sam's Bicycle Store had 200 bicycles in stock at the beginning of the year. The cost of these bicycles was $19,000. During the year, he purchased another 400 bicycles at a cost of $35,800, providing $54,800 worth of total goods available for sale during the year. Sam took an inventory at the end of the year and determined that the cost of the 135 remaining bicycles was $12,330. Subtract the ending inventory from the goods available, and you have $42,470. In manufacturing accounting, several other costs can be added to raw materials before determining an accurate reflection of the cost of goods sold. For instance, part of the cost of goods manufactured is the labor that went into the process. In handling business returns as a professional tax preparer, it is important to at least understand that except for service-based businesses, such as a tax preparation service, every business client is subject to this equation. Gross sales minus cost of goods sold equals gross profit. So the term gross profit refers to the amount of profit that remains after all sold inventory is accounted for and subtracted from gross revenue. Other business expenses are then subtracted to calculate the net income.